Okay, so I think we are ready to start. I see that a few more people have joined, and I think people will still join as we go along. So for those who are here, thank you very much for joining this dialogue today, and good afternoon, good morning, or good evening, depending on where you're dialing in from. Welcome to our A2ii-IAIS public dialogue on pandemic risk, the opportunities to improve insurability. My name is Caroline Barsulai, and I'm a member of the A2ii Secretariat. And for our new participants joining this dialogue for the first time, in general, these dialogues are a joint initiative with the with the IAS, and they deal with current and relevant topics that supervisors in the insurance sector are faced with, and they also provide a platform for knowledge and peer exchange. So before I hand over to our moderator for today's session to kick off the discussion, I will go through some quick logistical information that will guide our participants for today. So first of all, this is a public and open dialogue, and it is being recorded. And to improve the audio quality of the session, you are muted during the presentation and also during the discussion. We have saved some time at the end for questions, so feel free to post your questions in the chat box on that right-hand side of your screen as the discussions are going on, and we will have some time to address it at the end. You can also unmute yourself by clicking on the microphone icon next to your name if you have any question, and the moderator will direct you as appropriate. And if you encounter any technical issues during the discussion, feel free to also post this in the chat, or you can also send us an email, dialogues@a2ii.org. Also, finally, we have simultaneous translation available for this session for our French and Spanish speaking participants. As you can see the instructions on the slide on the screen on how to access this. The instructions will also be posted shortly in the chat. So one, you can stream the translation directly using the link available in the chat and also as indicated here on the screen, or you can access the Interaction application on any iPhone or Android phone by downloading the app on your phone and enter the code A2ii-IAIS and select your language of choice. So I will now hand over to our moderator for today's session, Alistair Gough, who is an Executive Director at the IAS, Executive Coordinator at the IAS, and is also the lead on IAS work on pandemic risk protection gaps. Over to you, Alistair.
Thanks very much, Caroline. And good morning, good afternoon, and good evening to everyone on the call. Welcome to today's webinar on pandemic risk, opportunities to improve insurability. It gives me great pleasure to moderate today's webinar on this very interesting and important topic. The past 18 months since the outbreak of COVID-19 have exposed significant insurance protection gaps, which in turn has triggered an ongoing discussion and debate about the role of insurers in bearing the losses related to pandemics. The insurance sector in the past has been adept at developing insurance products to meet the changing needs of society. However, the COVID-19 pandemic and the subsequent lockdowns, business closures and restrictions on travel and movement has highlighted the limits on types of coverage that can reasonably be offered by the insurance sector alone. In fact, the COVID-19 pandemic has fundamentally tested the conditions of insurability, causing significant hurdles to the development of insurance risk transfer solutions. For instance, the risk diversification required to support viable insurance cover has been challenged by the fact that the pandemic has hit countries right across the globe simultaneously, and has also affected a wide range of sectors, meaning that it's not possible to spread this risk within a collective and over time. Furthermore, insurance premiums also need to cover the cost of capital and at the same time be affordable to the insured. And research indicates that effective market insurance coverage for pandemic risk or the COVID-19 pandemic would necessitate rates which would likely be unaffordable or unattractive to consumers. So these are no doubt very significant challenges. In some countries, we've seen solutions proposed in the form of pandemic risk facilities or pandemic risk pools. A number of these, which focus on non-damage business interruption cover, are listed on the slide that you can see on the WebEx. And we will hear from one of our panelists about the pandemic risk pool proposed in India. Some of these initiatives have been proposed by industry, others are government driven initiatives, but the common theme is that they all propose some form of public-private partnership supported by a government backstop. So during the webinar, we'd also like to explore other ideas and initiatives, including things like expanding data availability, risk modelling, innovation, and other ideas that could potentially expand the boundaries of insurability and how the insurance sector could potentially contribute to providing financial protection for future pandemics, as well as other systemic risks. So with that introduction, it gives me great pleasure to introduce our panel for today. So firstly, Ms. Hannah Grant, the head of the Secretariat of the Access to Insurance Initiative. Welcome, Hannah. Dr. Gunther Kraut, who is the Global Head of Epidemic Risk Solutions at Munich Re. Welcome, Gunther. Mr. Suresh Mathur, the Executive Director at the Insurance Regulatory and Development Authority of India. Suresh was also the chair of the working group on the Indian pandemic risk pool. So welcome, Suresh.
Good evening and thank you.
Good evening. And Mr. Leigh Wolfrom from the OECD's Directorate for Financial and Enterprise Affairs. Welcome, Leigh. So it's great to have you all here joining us today. So with that, I'd like to now move on to the first part of the session, to the panel discussion, and start with the questions for our panelists. And Hannah, I'll start with you with a bit of a scene setter, really, and it's a question in two parts. And the questions are: firstly, why is it necessary to address pandemic risk protection gaps? And secondly, drawing on the work that the A2ii has done, including the webinar series that was run last year, what has the risk changed in the past year, and if so, how?
So thank you, Alistair, and hello everybody from me. So yeah, starting with your first question on why it's necessary to address pandemic risk protection gaps. I mean, insurance plays not only an important role in support of economic growth and helping economies to function, it's vitally important societal in helping individuals deal with unexpected risks so they don't fall back into poverty or have to resort to informal coping mechanisms. In this context, the pandemic exposed significant protection gaps where insurance was not available or the coverage was not enough. Business interruption losses stole the headlines, but significant protection gaps were also exposed in mortality and health, with people not having the savings needed for out-of-pocket expenditure on healthcare or funeral expenses, and breadwinners' unemployment or even death, leaving families exposed. Where no commercial insurance cover exists, the risks are borne by policyholders, customers, and ultimately by governments, and therefore the taxpayer. This approach is neither sustainable or conducive to building resilience and leads to further exacerbating already existing social inequalities. And when you're looking at developing countries, and this is especially the case there, where you have 70 to 90% of people who are working in the informal sector, and therefore not only do they not receive any support from an employer during these challenging times, it also means that government revenues are very small and the opportunity to provide support through social protection is very limited. And therefore, some form of private insurance solution is all the more important. The insurance solution has the tools, I think, to make a real difference. And I would argue it's also a social responsibility to do so. No other sector is so well placed to manage, mitigate, model, and transfer risk. I recognise that due to the global nature, size, and the critical influence of political decisions, business interruption claims are widely felt to be uninsurable. However, even here, the sector can draw from a long history of risk management, as well as established claims handling procedures and channels of communication with policyholders to help facilitate a better response in the future and build pandemic resilience. So how has the risk changed in the past year? Well, if I were to compare where we were a year ago during the A2ii's IAIS A2ii pandemic risk series, well, for a start, it's gone on for a long time. I mean, this time last year, I was in home office, and if you told me a year later, I would still be in home office, I would have been quite surprised. but I'm no longer sort of working from my window still. I now have a desk and I have a proper office. So it's just an example of, we've adapted. So I think to look at the risk like how it was a year ago, I think businesses have adapted as well. So the risk is actually not quite the same as it was before. Otherwise, I think looking at the solutions that were discussed in the webinar series last year, I think the solutions there were, as they are now, I think very much focusing on public-private partnerships, but there the focus was very much on the pandemic itself. Whereas now I feel the dialogue has moved on a bit, and we're now looking at how cover can be provided for future systemic risks, so not just pandemics. I feel parallels are being drawn with climate change and natural disasters, and the two issues are no longer be seen in isolation. What I think hasn't changed is I've just already sort of alluded to, and I think Alistair also mentioned in his introductory comments, is that the events are too wide-ranging for anyone, public or private, to carry the risks alone. And therefore, there are a need for public-private partnerships and solutions, and us all to work together to think up new ideas and new innovations. And with that, Alistair, I hand back to you.
Thanks very much, Hannah. And it's very true that I think we've all started to adapt to this new normal. Leigh, can I turn to you again for a sort of a contextual question, I suppose? But has the pandemic highlighted a common set of protection gaps across the world? So looking at it, I guess, from the geographic perspective, and has the impact been felt more in some countries or regions than others?
Sure. Thanks, Alistair, and thanks to the A2ii and the IAIS for the kind invitation to participate in this discussion. So I think it's well known among those involved with insurance issues that there is a significant gap between the amount of economic losses, such as damage to property, business interruption, and income losses that result from many types of catastrophe perils, and the share of those losses that are insured, particularly, but not only in emerging and developing economies. We recently did some analysis to try and estimate the magnitude of these gaps for a number of catastrophe perils in OECD countries. And for natural catastrophe perils, about 55 to 60% of economic losses since 1990 were uninsured. And there are particularly high levels of uninsurance for floods and earthquakes. For cyber risks, for which the availability of data is much more limited, we estimate that about 85 to 90% of economic losses were uninsured. And I think it's highlighted by Hannah already in the context of COVID-19 and subject to some of the disputes and litigation that are still ongoing related to this topic about the applicability of insurance coverage. I think it's still nonetheless pretty safe to say that more than 99% of the revenue losses that businesses faced as a result of lockdowns and changes in economic behavior went uninsured. I think it's important to note that there will always be a gap between insured and economic losses. Some buildings and some revenue streams are unlikely to ever be insured. For example, governments or even large corporates with good access to capital and lending markets may find it more cost effective to self-insure some portion of their risk rather than transfer it to insurance markets. What is problematic is when the level of uninsured losses faced by households and businesses or even governments is beyond their capacity to absorb or manage. And that's where financial vulnerabilities and economic hardships emerge. I think there are significant differences as to why these protection gaps exist for these different perils and how intractable the problem remains for some of them. So for natural catastrophes, I think in general, and don't get me wrong, there's still lots of work to do. I think in general, we do have the knowledge and tools to better manage the risk and reduce the financial vulnerabilities. Catastrophe models exist in most places, not all places, to price the risk and manage the exposures that insurance companies take on. And those models can be used to identify where high levels of risk lead to challenges in insurance availability and affordability. We know that households will usually underestimate their exposure to natural catastrophes and how to address somewhat those biases through the way that insurance is offered. There are many countries that have achieved high levels of protection from natural catastrophe risks. Of course, climate change will make this all much more difficult in the future. And there are, of course, particular challenges in emerging markets and developing economies where households have lower financial capacity to acquire insurance coverage, and there's much more limited penetration of property insurance in general. Cyber risks, I think, are somewhat different. The modeling is less developed, the risk is less understood. The effectiveness of protective measures change over time as hackers improve their abilities to evade cybersecurity defenses. And importantly, for the insurance sector, there's very little ability to diversify any cyber risk that they do assume on a geographic or sectoral basis. Cyber attacks affect businesses in all countries and all sectors. Also important for insurers is that cyber attacks can affect many policyholders at the same time, either through a mass campaign or by attacking a ubiquitous IT service provider, such as a cloud service. To manage these risks, insurance companies offer relatively low limits, and reinsurance companies offer limited catastrophe coverage, such as excess of loss reinsurance. And this, as well as lack of risk awareness and some remaining confusion about where to find cyber insurance coverage across different types of policies, is probably the main drivers for the significant gap between insured and economic losses for cyber risk. Similarly, truly global pandemics have many similarities to cyber risk, I would say. There really is no ability to diversify, as Hannah mentioned, and Alistair mentioned, across different countries. The potential loss magnitude is probably much higher than you would have for a cyber event. We estimated, for example, that businesses in OECD countries suffered about 1.7 trillion in revenue losses for every month of strict lockdown measures. Although different from cyber risk, we do know to some extent, well, all sectors will be affected. We do know which sectors will be most affected. Businesses that depend on the physical presence of employees or customers will be the ones that are most likely to be required to curtail their operations. If coverage were available, those sectors would face very high premiums. And as a result of these issues, as well as the practice of attaching business interruption to property damage, insurance coverage for revenue losses related to infectious disease outbreaks is pretty much non-existent in most countries. I think what COVID has truly highlighted, as Hannah mentioned, is that large-scale, even systemic events can happen, and that the insurance coverage that some might have expected to be available is not available and probably cannot be available without some form of public intervention. It's also brought, I think, greater awareness of the potential benefits of ex-ante coordination related to the respective roles of governments in the insurance sector in responding to these types of large-scale events. For example, many of the government interventions involve enhancements to things like social security safety nets, unemployment insurance, for example, which reduce the funding needs of businesses affected by lockdowns. And so therefore you have to ask the question, does any insurance solution for pandemics really need to provide a comprehensive level of coverage for business revenue losses, or just something that allows continuity? It has also led to some really new, interesting thinking about how insurance products could be designed to respond to these types of events, and I think we'll hear more about that from Gunther in his remarks. And in the case of emerging and developing economies, COVID has almost certainly created additional hardships. While insurance coverage did not respond to losses anywhere in emerging and developing economies, as Hannah mentioned, it's clear that social safety nets are less available than they are in developed countries, and that developing country governments have less fiscal capacity to develop other programs to support businesses and individuals affected. And I think Suresh will give us a good example in India of how one such vulnerable segment of society was targeted by a proposal to provide this kind of financial protection. So I'll stop there. Thanks very much.
Thanks very much, Leigh. It's certainly a very complex set of problems, and you have given us a nice segue into the next question to Gunther. But before we do that, as Caroline mentioned at the start, to keep the session as interactive as possible, we do have a couple of polls which we wanted to run, and so we'll run the first one of these now, and we'll move on to the next question while our attendee participants make their selection. So the question is, what is the most effective mechanism for managing the business interruption protection gap caused by the pandemic? With options of public-private partnership, industry-only solutions, government-funded schemes, or self-insurance. So we'll give you about 90 seconds to respond to that. And in the meantime, I will move over to ask the next question to you, Gunther. And that is, I mean, drawing on your expertise, how is pandemic risk and epidemic risk different? And do different approaches need to be taken to provide cover against these risks?
Thank you, Alistair. Thank you, Leigh, also for the kind words. Good evening. Alistair, let me split my answer in two parts. At the risk of boring you with things that you all know already, I'll tell you a little bit about the risk itself, just to lay the framework, how to then talk a little bit about how products may look like. So what is important to understand is that there's really a constant disease activity going on all the time at the globe. And you can tell from the World Health Organization reporting around 200 outbreaks every year. Now, most of them are small. A few of them turn larger. These are the ones you read about in the newspapers, the Zikas, the Ebolas, the MERS and SARS. And obviously then you can have the global pandemics such as COVID-19. It is really like a pyramid of events. And hence, it really is not a black swan event. There's a lot of data actually to see what is going on in there. And it is important to note that there really is a significantly increasing trend in both frequency and severity. And just if you look at the simple fact that there have been 3 significant coronavirus outbreaks over the last 17 years, SARS, MERS, and now COVID-19, that is not a coincidence. There are modeling agencies out there who say that, who have published numbers, that within the next 25 years, we have a chance of 50% to see another event of the same or even larger magnitude as COVID-19. And what is really distinct for epidemic and pandemic risk is that each of these smaller epidemic events has the potential to grow into a large global pandemic. And that is different from other risk factors because there's a time structure to it, and you may interact with the event, you may contain it, or it may spread further. For an earthquake, you know in the moment of occurrence which scale it was, and that is not true for epidemic risk. That, however, really poses a significant challenge for the concept of diversification, for the law of large numbers, because that leads to a fundamental breakdown of the concept of diversification. And hence it leads to a fundamental breakdown of the concept of insurance. And that is very clear, hence, why the accumulation risk is too large to be borne by the insurance industry alone, whereas pricing is actually not the problem. There's data out there. But for this accumulation scenario, you can't work with a PML approach. You need to work with hard limits. And that is why the capacity is so constrained. Now, leading over to the products, now you will say, why is it that Munich Re already since 2017 has a particular business unit for epidemic risk solutions? And the answer is quite simple. It's not only that we felt there's an insurance gap, but the solution can only be that we need to bring in many shoulders to help carry the risk. And that can be private sector investors, that can be public sector investors. We as a reinsurer, we feel we are in a natural role as a market maker, as an aggregator, but also transformator of the risk so that it can be made accessible for other sources of capital. And I'll just give you a very brief description of the business interruption, of the non-damage business interruption products we are selling on the market. And maybe just to highlight, it's not theoretical concepts. So we are selling these policies, we have sold the policies, and we have placed risk with capital markets investors also since the pandemic started. So the one challenge you need to overcome, again, relates to the core of infectious diseases. And I take a very simple example of a hotel. If a hotel thinks about infectious diseases, on the one hand side, you may have Legionella in the water system, which is really more of a very localized hygiene problem. On the other hand, you have these large-scale epidemic outbreaks that we are experiencing right now. So the product trigger needs to be very clear, or the event definition, what is insured. You don't want to have ambiguity. And there are different trigger concepts or definition concepts available, the ones which we are currently finding most interest with clients and customers, is focused on these large-scale epidemic events. And in a way, it's very simple. A, you need to have an epidemic outbreak, such as reported by the World Health Organization in a DON, in a disease outbreak news. Secondly, the outbreak needs to reach a certain scale. For example, a public health emergency of international concern is declared by the World Health Organization. And thirdly, as these two first steps are global steps, you need to somehow pin it to your geographical location of the insured interest. You can do that, for example, by observing local transmissions or by saying civil authority restrictions occur locally. And then it's very clear and also observable that you have an insured interest. And in that instance, the economic losses can be picked up by an insurance policy. And looking at the audience and knowing that there are many insurance regulators in there, let me maybe just close with two comments which are of relevance. If you look at such products, it's important that the time structure of an outbreak is properly incorporated for two reasons. First of all, you want to be very sure and certain which is the policy period that the event is covered under, as we clearly deal with events which can last for a certain while. Secondly, you want to have a product without insurance gaps. If you trigger too late in the timeline, clients might face problems in a renewal situation. So if a small outbreak has already started. So these are things which you can consider. And just closing with really looking across non-damage business interruption in general, but really looking at the wider scope of epidemic risk insurance products. Maybe also worthwhile noting that pre-COVID-19, we clearly had more business success on the life reinsurance side, whereas and not so much on the non-life, non-damage business interruption sides, even though the products were available as well. And it has to do with regulation, because on the life insurance side, life catastrophe risk, i.e. pandemic risk, is for very long a regulated risk factor, and that has implications. But I close here for now, Alistair, because I believe you want to guide us through the results of the polling.
Yeah, thanks very much, Gunther. And I think we've got the second question up there, so I'll tell you what the results were. But it was actually a very clear majority selected public-private partnerships, with about a third, I think, just over 30% or 40%, and then coming in a distant second, actually, were industry solutions. So I guess just, do you have any reflections on that, Gunther? And I guess maybe the question is that an expected result? And why do you think public-private partnerships sort of can or do provide a viable solution?
No, it's not surprising. I think it's indeed necessary if you really want to have a scalable solution with the potential to make economies to a larger degree more resilient. Then there is no way around it, just for the sheer amount of capacity needed. So whenever you have that ambition, there are two key challenges to overcome. And the one is the accumulation problem or the available capacity. And the other problem is the affordability, as Anna has already stated before. Now, the PPP concept, which we have developed, is, we call it the Epidemic Risk Markets Platform, and I believe the paper and details of it will be shared afterwards. So one important difference is, compared to other approaches we have out there, overcoming these two fundamental key challenges is hard if you have the ambition to find a solution for the whole market from day one. So we try to change the viewpoint and say, let's really focus on the development of a specialty market segment, because then we have a lot of tools, a lot of things which we can already do today, and to really accelerate that development. And that is crucially important to get some risk adequate mechanisms into place, because that is the way how you also create the incentives for better preparedness. So how could that look like? You, of course, and that's reflecting or referring back to when I said that a reinsurer could be a natural aggregator and transformer. So of course, we need to provide the products with a proper pricing, with a proper wording and underwriting to the policyholders via the infrastructure of the insurance industry. But then the risk really needs to be transformed so that both capital market investors and private sector investors can participate. And to a degree, it doesn't matter if the investor is a public or private sector investor, but it is important to really have both of these market segments, the epidemic risk insurance market and the pandemic investment market, grow at the same speed, because only then it can work, because all stakeholders in the value chain will have certain constraints on capacity. Now, Alistair, that addresses the capacity, which can be growing and crowd in further capacity, but it doesn't address affordability. And if you want to make that whole mechanism more affordable, acknowledging that there's a very high expected loss, then we'd suggest you could combine insurance with contingent lending in one hybrid product. And to give a very simple example, so you have a product, as I described before, the event happens, the insured receives $5, and after the event is over, the insured can keep $1, but then having survived the event simply needs to pay back the other $4. And that combined solution, we believe, is quite attractive for the policyholder and meets also his need of a high inflow of liquidity while being affordable. And we believe it also should be quite a compelling proposition for the public sector, because there are no subsidies required. You can address affordability, and you really can also use the existing infrastructure of the insurance industry for an ex-ante solution. But I'll stop here to not overwhelm you with details, because there's more things to add.
Thanks very much, Gunther. And I think we have received a question in advance around public-private partnerships. So depending on how we're going with timing, we can potentially come back to talk a little bit more about that. But I think your mention of the challenges of affordability and also your mention of regulatory considerations is also a nice segue to our next question, which is to you, Suresh. And we'd like to ask you, I mean, the IRDAI has been particularly proactive in this space with the considerations around a pandemic risk pool. Can you tell us about what the incentives were behind the pandemic risk pool initiative in India? And then second, I guess more broadly, what role do you think supervisors can play in the development of initiatives to address pandemic risk?
Good evening, everyone, and thank you for inviting me here. The pandemic and the consequent lockdown triggered migration of thousands of daily wage workers in India who were working as, say, construction workers, working in various factories and establishments which were shut down during the lockdown. So business interruption policy does not cover lockdown, and it triggers only when there is a physical loss to the property. So this loss of employment also had impact on ability to access basic necessities such as food, accommodation, and health. There was a feeling within our setup to prepare our sector to handle this kind of massive risk and see what role the insurance sector can play. So IRDAI assumed the role of a facilitator for a working group and provided a platform wherein all the members, insurance and reinsurance experts, deliberated with an open framework, and it also helped in inviting leading international experts to share their views. These experts came from super national agencies, foreign insurance and reinsurance giants, and global intermediaries and insurance councils. We have to play a role of a leading role in ensuring these pools, on one hand, take birth and then keep shaping up with the changing needs. It is quite clear that such pools which have a global accumulation would be formed alone by the insurance capacities or reinsurance capacities would need larger amount of fiscal support from the central or the federal governments. The regulator could act as a bridge between the pool administrator and government bodies. It could also provide its guidance on coverages, asset deployment to the pool administrator. So IRDAI sees its role post-pandemic pool formation to ensure the capacity deployment by the local players is within their adequacy requirement and risk appetite. We have provided a platform to collect data and have working group members provide the inputs on data analysis and interpretation. The working group members identified various steps, like understanding what is happening globally, and in some other countries where pool discussions were at an advanced stage. Then conceptualizing the research questionnaire, focusing on product structure, premium paying capacity, insurers and local reinsurers' appetite to assume such risks. So the working group set up a list of industry seniors and mid managers from where the responses were desired. So IRDAI assisted in disseminating this questionnaire so that the responses could be quickly made available from the industry seniors, CEOs and CFOs, CROs of industry forums and industry forums like Confederation of Indian Industry, FICCI, SOCHM, and local trade associations. So IRDAI played a role in supporting the working group in developing a framework to define triggers based on its own assessment and local factors and global inputs. So that's the role played by the insurance regulator. So I'll stop here, and if I am ready for the further questions and expanding anything which you desire.
Thanks very much, Suresh. I mean, that's you set a very interesting platform there. And can I maybe, Hannah, turn to you as well with the second part of that question, which is around, you know, what role do you think supervisors can play? And I mean, I guess drawing on the work that the A2ii has done in this space to date.
Sure, no, happy to answer that question, Alistair. And I would start off actually by mentioning the survey that I think, I mean, you're well aware of, that the A2ii has been doing together with the IAS, and we've actually interviewed a few different insurance supervisory authorities to find out what they were doing in their country to try and support pandemic risk coverage. And actually what we found out overall is that by and large, actually the insurance supervisors were not actually so involved in setting up schemes in their country, that in most cases it was actually the government who was taking sort of the leading role. And in a lot of cases, actually not even with the involvement of the insurance supervisory authority. However, I mean, that said, I think what we've just heard from Suresh is a very nice example of the role that the insurance supervisory authority can play, and very useful role that an insurance supervisory authority can play in a country, where they're providing the technical expertise, you know, the expertise on how insurance works to the government. They're liaising with different stakeholders, both private sector as well as the public sector officials, to help set the scheme up. So I think on that, I mean, there's a lot of potential of what insurance supervisors can do. And then just looking at more broadly and trying to encourage, let's say, private sector innovations to come into this space. I think the insurance supervisors do play a big role in putting the right sort of enabling environment in place. And in addition to this, actually just encouraging sort of innovation. So this could be through things like sandboxes, innovation hubs, or just allowing pilots to happen in jurisdictions. So this all encourages the industry to come in and think and provide new products to the market. And then obviously financial stability is very important, and insurance supervisors here, you know, we've seen are working on stress tests with the industry to make sure that the industry continues to be financially resilient if an event like this were to happen again.
Thanks very much, Hannah. So I would note a couple of things. I mean, firstly, I note that in the chat we've got a link there to the report from the working group on the Indian pandemic risk pool. And so having looked through that, I know a huge amount of work went into that, Suresh, and it is a very, very interesting body of work. So I'd encourage people to read through that. Look, in the interests of time and to hopefully leave a little bit of time for questions and answers, we'll keep moving onto the final round of questions. And the final round of questions is the same question, but noting the different perspectives and experiences we've got with our panelists, we'll go around and ask each of you in turn. Before I do that, I'd also just like to draw attention to another poll which we ran in the background, and the question for the second poll was, what type of systemic risks will challenge the capacity of traditional insurance models to provide cover in the future? And Leigh touched on a few of these in your opening response. The options we put up there were pandemics, climate risk, cyber risk, none or other. And climate risk was the one that was selected as the highest majority of attendees selected, followed by pandemics and then cyber risk after that. So that's an interesting response as well. So look, I will go to the final question now, and I might stick to the same order and come back to you again, Hannah, first. My question is, what are your concluding or summary thoughts on how governments and the insurance sector can address future pandemics or other systemic risks?
Well, one topic we haven't really touched on so far, but I do think governments and insurance supervisors have a big role, is financial education and literacy. So I think they can really play a big role here in boosting awareness of the risks and things that people are facing, so they're more aware actually in some ways of their risks, but then also the opportunity offered by insurance to help build their resilience and protect them against this. So I think COVID-19 actually on this has provided a great opportunity, let's say, for the insurance sector. It's been a big wake-up call. It's been a real building awareness of people of the risks that they're facing. I think in areas such as health and life coverages, we've actually seen increases in the amount of coverages taken out as people become more aware. And I think government should also seize this opportunity to help increase people's awareness generally of some of the other risks they're facing as well. And as I say, the role that insurance can play in protecting them and this. Yeah, my response there is just quite short, but really just to say financial education and literacy and a greater focus on that.
Yeah, thanks, Hannah. Leigh, can I turn to you with the same question? I mean, I guess you touched on a few of these points, but interested to hear you expand on the questions around how you think the insurance sector and governments can address future pandemics or systemic risks.
Sure. So first of all, maybe I'll build a little bit on the point that Hannah made, and also maybe a little bit around the role of supervisors. I think, you know, one of the things that definitely came out of this experience is a lot of how much uncertainty there really is among policyholders about the coverage that they have, and so I do think that there's a role for the insurance sector, and I think the insurance sector knows that, but maybe also supervisors in how they oversee on ensuring that there really is clarity of what is covered and what is not covered in an insurance policy. I think that will, that's sort of the start of the solution. I guess the second thing, so we actually organized an event on this topic, as probably many organizations have over the last year and a half, and I think when we also did some audience polling, which was similar to what you've done here. Our audience was very much focused on the insurance sector, and so there might be a bit of a bias in some of the results. But I think there was congruence generally with what you had here, what you found from this audience. But one of the things that was I thought was really interesting is that there was actually we asked whether or not there was a real opportunity to sort of reduce this risk in the future, and what were the most important things that would lead to reducing this risk in the future, and basically supporting insurability. And by far the most significant response was around improving the public health systems and the public health response to these types of events. And I think governments will admit that they were taken off guard to some extent on how to manage this. And beyond the insurance sector, asking governments to do more to reduce risk. I think even many of the public health experts that we invited to speak, had a clear message that we can all do better next time and sort of reduce, stop the global spread as Gunther mentioned, and turn, keep these as epidemics and local events rather than global pandemics. And so that's one thing I thought I'd mention. The second one, just to sort of complement the polling results, is we had a fair bit of representation from the business community at the event, and there definitely was a clear preference for some type of insurance solution rather than government support. I think there was a real reluctance among the business community to have to depend on the whims of government financial support if this was to happen again. And so there was really an interest in finding some sort of public-private partnership to make this kind of insurance coverage available in the future. I'll stop there. Thanks.
Thanks very much, Leigh, and you gave a nice platform for Gunther there as well. Gunther, can I turn to you with the same question now? Obviously, you've been very heavily involved in thinking about all things epidemic and pandemic. What are your I guess a brief summary in terms of how you think the insurance sector and governments can address future pandemics and or other systemic risks?
Keep it rather short, Alistair, because I've been talking a lot before. So maybe just 2 points. I think the first point is really echoing what Hannah and Leigh said, but it's just so crucially important. Don't let go after the event. Keep the awareness up. It's just so important because we likely all live to see the next event happening. So we want to have a better preparedness the next time this happens. And the other comment I would just simply make is think small to act big. Because it's actually easy to do something and to start maybe in your region and your responsibility, try to get a first pilot transaction implemented. Because transactions will attract further transactions. And that is so important to kind of really scale this up in sync on both sides of the insurance and on the investment side to really overcome this chicken and egg situation. And hence really, if you are a public sector investor, help us to implement a transaction and note with your investment, not with your subsidies.
Yeah, thanks, Gunther. And finally, Suresh, I mean, I guess you lived and breathed this for a while as the chair of the working group on the risk pool. Drawing on your experience, what are some of your thoughts and I guess conclusions on how governments in the sector
considering the very complex nature of this pandemic risk, it requires very close cooperation by the public and private sectors in managing its impact, and also restoring confidence in the functioning of markets, economies, and society at large. Key to building a more proactive and agile response to the next pandemic will require partnership of insurance and risk management, and that would have facilitate what coverages aligns the desires of both insurers and insured to avoid losses, and incentivize pandemic risk preparedness and mitigation efforts. The pandemic risk is too systemic to be covered by the insurance industry, and yet we will need insurance to enable business to keep trading and to help kickstart our economy following the lockdown. COVID-19 has demonstrated the potentially significant limitations around the extent to which the property and liability insurance can respond to pandemic-related losses. Due to accumulative nature and lack of diversification characteristics, the insurance sector would have to work in tandem with the government resources to ensure good governance framework is created in the form of backstop, which could reduce over the next few years till such time pool accumulates enough reserves to prepare for a large event like this. Government could also support in terms of ensuring coverage is mandatory. They can make it mandatory, the cover, particularly for the MSME segment, to help reach out to large population and provide the benefit of risk spreading principle of insurance. So that are my thoughts as of now, sir.
Yeah, thanks very much for that, Suresh. And I think that final point is a very interesting one, but a slightly vexed one of mandatory cover. So I know that's a debate that's happened in other countries as well as to whether that is a condition put on a risk pool or a facilities going forward. Look, we've got a bit of time. We've still got another 10 minutes actually. So what we might do is move into the Q&A part of the session. And firstly, thanks very much, panelists, for your responses so far. So we've had we've got one question in the chat here, which I might come to first, and then we had a couple come in before the session. So Gunther, the first one is for you, and it's in the chat from Dennis Garand. And I think what I'm going to ask you here is a very difficult thing of trying to explain a very difficult question in a short amount of time. But the question is, Gunther, what is the cause of the increase of epidemics? Is it environmental degradation and or increased population density?
Well, it's not as easy and not as difficult to summarize, actually. The details are complex and but there's much research into that, and much of it really has to do with our way of living. So we are invading more and more into territories where so far animal populations have been undisturbed. Now the human population invades, destroys habitat, so the animal population gets out of balance. And in a nutshell, that makes it much more likely that when you meet an animal there, that animal is carrying a new infectious disease because that animal population is not in balance anymore. And then, of course, the urbanization, the greater global mobility, just help a lot to spreading these new outbreaks reaching the human population.
Thanks, Gunther, for the concise answer. Just scanning the chat, and I would encourage members of the audience to put questions in the chat if you have them, and also just to flag that we have put a publication from Gunther, the details and the web link to a paper from Gunther in the chat there. Another question that did come in beforehand is a topic that we touched on, but perhaps we can come back to it, and that's the question of, and perhaps Leigh, I can start with you for this one, but public-private partnerships, are they the only solution to addressing pandemic risk? And the second part of it, why have these initiatives been so challenging to implement to date?
Thanks, Alistair. I think they are. I think any sort of mass market solution, as I've heard Gunther describe it before, there isn't sufficient capacity in the insurance sector. You don't need some form of government backstop for the truly systemic set of losses. If you're going to make coverage available at all, it's possible that the world will just continue without much coverage, and the next time this happens, the policyholders and the businesses will face the losses again, although we're all, of course, working to avoid that in the future. In terms of your second question as to why it hasn't happened, I think, first of all, governments are still fairly busy dealing with the crisis, and so I think there probably hasn't been a lot of time to focus on coming up with a solution for the next one that everyone hopes will be, another 100 years away, even though Gunther tells us otherwise. I think the other issue is that many governments are actually questioning to some extent whether or not the best way to deal with these truly systemic events is through some form of insurance solution, or to do similarly to what they've done this time. I mean, I think even the lessons from the global financial crisis in terms of how governments provided support to the financial system, to businesses, were in many ways replicated in the context of COVID-19. And so in some ways, governments are getting better at addressing these kinds of risks as well. And so maybe they will feel that the most efficient way to do it is to do it themselves. And then lastly, I do wonder if the old challenge of low risk awareness and potential expectation of government assistance next time. It's also sort of reducing the amount of demand from the industry, the beneficiaries, the business sector, from really pushing for a solution at this point. I don't have any evidence to suggest that. In fact, I probably have heard only the opposite, but I do wonder if that is a factor.
Suresh, I wondered if you wanted to come in on the second part of that question as well. Why have these initiatives been so challenging, public-private partnerships, to implement to date? These sort of, I guess, broad-ranging, risk facilities and things like that.
Actually, if you look at India, we are looking into this kind of partnership, but understanding the risk and also the enormity is posing a lot of problems, and there is no data available previously on the subject. But our working group had discussed this, and what we had thought is that to address the future pandemics, we can do first is that if as I had mentioned earlier, if the government makes it mandatory, particularly for MSME segments where large part of daily wage workers and laborers are working, the cover for this kind, and then capacity from the local players, insurers and reinsurers, that can be drawn, and then third part is the government backstop. So this is the broad guideline we had proposed, broad recommendations. So this is the way forward. That's what we think. And public-private partnership, we have regarding the capacity, we have private players also, and we have public sector players also, and both can involve themselves in this and offer capacity whatever best is possible as per their size. So this is what we have proposed. Let us see how we can go forward on this.
Yes. Yeah. Thanks, Suresh. We'll certainly be watching with a very interested eye in terms of developments from here. Well, in the last 4 minutes, I might be ambitious and try and sneak in one final question that we've had come in, and Leigh, I think it's probably for you as well. But the question is actually related to the Caribbean region, and the question or comment, I suppose, is that the observation that most of the damage in the Caribbean is due to uninsured property and disaster, as well as a simultaneous increase in severity and frequency, in particular of floods and hurricanes and earthquakes. The question is, can you comment on that? But perhaps I can turn that into a question and say, what options do governments in the insurance sector have to mitigate against these losses caused by natural catastrophes? And perhaps, is there anything that we can learn from these initiatives that could also be applied to pandemic risk?
Thanks, Alistair. I'll give that one a try. Actually, one of the interesting, I mentioned this already, one of the really interesting things that I think has come from our experience with COVID-19 is some new thinking around how insurance products can be designed, and adding new things like a credit element, as Gunther mentioned, adding sort of parametric coverages. Most of the proposals that you had on your first slide involve some sort of parametric type, loss basis. And I do wonder if those kinds of innovations have applications. I know they have some applications to other types of risks, like climate risks. And you could think, for example, Gunther, I'm going to steal your idea and talk a little bit about how you can imagine long-term contracts, long-term insurance contracts, or maybe long-term insurance commitments for climate risks that would sort of force insurance companies to take a longer-term view of future climate, and maybe somehow bring in some credit elements to those long-term contracts to actually help their policyholders reduce their level of risk. So that's just one example. But I think the type of thinking that's come out of out of COVID-19 experience, I think will give us hopefully some good ideas of how to deal with the changing climate that hasn't gone away through the last 18 months.
As I could just quickly echo what Leigh was saying. I mean, on the parametric definition, I mean, maybe it is also helpful to simply understand the choice of parametric definition as simply as your choice of deductible. If you choose a parameter for a large-scale event, that defines your risk appetite. If you want to be covered from the small-scale event already, then you need to have another parameter. But these kind of techniques help to make the risk more objective. And that is something which we all have learned, that there needs to be clarity if you are insured or not. You can't have vague definitions. And of course, many of the concepts, also the ones I've been talking about, can in theory be just as much be applied to other systemic risks.
Yes, thanks very much, Gunther. And I think really useful insights, I think, and to draw on the point that Hannah made right at the start, I think the dialogue has moved on a bit since we were having these conversations a year ago to thinking about the broader systemic risks that we face. Unfortunately, we're right on 3 o'clock now, so that will be the last question for today, as we've run out of time, and it's very difficult to address all of these complex issues in just an hour. But I hope that we've made a good start, and that the audience has had some got some really good food for thought on what is a very interesting and complex topic. So with that, I would just like to once again say a very big thank you to our panelists, Hannah Grant, Gunther Kraut, Suresh Mathur and Leigh Wolfrom for taking the time to join us today. It's been a real pleasure moderating today's webinar, and I wish I thank you, and I wish everyone the nice rest of the day. Thank you very much.
Thank you.
Thank you.
My pleasure.
Thank you. Bye-bye.